we should probably talk about sales by banks and what's likely to be happening this year and timescales and whether the banks have now sort of finally this year got themselves into the realization and understanding of what they got in sufficient detail to actually be crystallizing some sales. And certainly the meetings, more and more often, if we're not actually instructed by the bank, there's a bank sitting in the room together with the owner of the property, and we're sort of reporting to both entities. Philip, would you have a sort of view on the attitude of banks and relation to sales at the moment?
I think there's clearly a huge amount of pressure on the banks to deleverage their books at the moment, and that will continue going forward. The difficulty I think a lot of the banks have is that their mark-to-marketing has not really been necessarily very good over the last few years, and in order to be able to liquidate their portfolios, they're going to have to take bigger write-downs, and they're not really in a position to do that. They've got this huge problem with all the regulatory changes coming through Basel III and other regulations, so they've got to raise their capital against on their balance sheets, their Tier 1 capital, significantly compared to where they've been in the past. And some of the bigger banks, which are regarded as too big to fail, have got to double the size of their Tier 1 capital. So the consequence is that they are struggling to actually deal with the issue. I think it's actually been sort of made worse in recent times. I think we were expecting to start to see more loan sales coming through, banks actually starting to package up loans. But what we've, with all the sovereign debt problems that have been around and the damage that's done to their balance sheets, the central banks, the ECB and so forth, have just gone and lent them huge amounts of money at relatively low cost of capital, which actually defers their ability or their need to actually deal with these issues, and they allow them more time in order to start reducing their value, marking to market their books. So I think the workout is going to be take a long time to come through. We're not expecting a tsunami of assets coming to the market from the banks. And I think you can actually look across Europe and see them behaving in very different ways. I think actually in the UK, and one of the reasons I think why a lot of investors are focused on the UK is there's probably more stuff coming out of the banks than there is anywhere else in Europe. Because a lot of the other European banks are probably behind the UK banks. And I think the liquidity that we're seeing in the US market and the debt market starting up again is because they're way ahead of even the UK. They mark to market very early on. It's part of their regulatory controls. They have to mark to market. And they've sold off their debt and got rid of a lot of it. So they are in a position to move forward. So my view is we will see more stuff coming out of banks. It will be slow. A lot of the European banks are working on a 5 to 10 year workout program. But we will not see this huge tsunami. But there will be loan sales. I think the loan sales are probably going to be what I call the tail end of their book. Smaller assets, poorer quality. There are quite a number starting to come through in the market at the moment, but they're not necessarily the ones that where most of the capital, and there's a huge amount of capital focused on this area, but I think everybody's expecting to see better quality stock than the very small local type investments.
Thanks, Philip. Do you have any response from the panel just in terms of what Philip was saying about the banks? Germany, what's going on there, Peter, with the banks in Germany? Are we seeing any distress?
Well, I think it's fully in line with what we just heard. It's I think we've been quoted a couple of times that we thought they would loosen up earlier, but they haven't, and it'll be the same story as Philip said. We will see. It's not going to be a big flood of properties which are going to hit the market. The banks are sort of more or less in a prolong mode rather than a sell mode, but we are seeing properties or smaller portfolios here and there coming to the market. That's unfortunately the way it is, though.
Thanks, Chris.
In the United States, if you look at the delinquency rates around the insurance companies, they were nominal, whereas the banks had significant problems. What's interesting about the U.S. banks today that still have some of these loans on the balance sheet, they continue to sell notes. and there were billions and billions of dollars of notes that were sold in 2011. We think 2012 will be like unto it. We won't have some of the big Irish sales that we had last year, but I'd project at least another $10 billion of note sales in the U.S. But with the banks, there's been a forbearance. You know, they've been extending them once, extending them twice, and so they're getting to the end of their ability to deal with this, plus their Tier 1 capital has been raised to a level that they can now deal with some of those delinquent loans or those situations that they have been kicking that can down the road. So while we won't see a flood of it, we'll see more of coming to that final moment on some of these notes, and we'll see some of that product hit the market.